This is Matthew Cratter from Trader University, and today I want to talk about government inflation propaganda. And be sure to stay tuned till the end of the video when I'm going to talk about different ways to hedge against it and how that has worked over time. If you're interested in learning how to make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So inflation is generally described, and we all know what it is, as the loss of purchasing power. $20 used to buy a certain amount of groceries in 1929. It bought less groceries, fewer groceries in 1960, and even fewer today. When I was a kid, people still used to pick up pennies and quarters off the ground. Now there's no reason to do it. Hamburgers used to cost 45 cents or 50 cents. Now they cost $5. We all know intuitively what inflation is. Inflation is measured officially by the Consumer Price Index. You've probably heard about it, the CPI. And what I would maintain is that this is just a government-created statistic. It's highly manipulated, and it really understates inflation, unfortunately. And so here's a chart from the Federal Reserve showing changes in the CPI, changes in the inflation rate, or actually the inflation rate over the past 10 years. Now, the Fed, the central bank, has been targeting inflation of about 2%. And you can see, according to this, they've approximately hit their targets. Now, one problem with managing an economy to hit certain statistics is that you end up creating a lot of distortions. And I believe that's what happened. But just on the face of it, if you look at the CPI, it really has tracked this 2% level. At times it's been above it. At times it's been below it. We actually had a little bit of CPI deflation in early 2015, and we almost had it in 2020 when everyone was staying at home during the COVID crisis and not buying anything. But this is the official government measurement. Now, why would the government have a motive to understate CPI? Well, one of the biggest reasons is that Social Security and Medicare payments are adjusted annually, I believe, by using the CPI. And so the more slowly the CPI goes up, the less inflation there officially is, the smaller these cost of living adjustments need to be for these really huge government programs that, as time goes on, will become an increasingly large percentage of the budget and hence the budget deficit. So we know that the government has a motive to understate CPI. The Federal Reserve is also printing lots of money and driving up asset prices, which helps the rich and hurts the poor. And so there's a real incentive for the government to hide these cost of living hikes, this inflation that predominantly hurts working and middle class people who don't have a hedge in the form of stocks and real estate. Now, I'm not going to go into all the technical details of the CPI, but I'll just point out one example, which is the substitution bias. So the way the CPI is currently constructed, if you used to eat steak 10 years ago, you had steak a couple times a week, and now you've had to switch to hamburger a couple times a week simply because steak has become too expensive. And then let's say in the last year you've had to switch to cheaper things like soy burgers or something that's even cheaper than ground beef. This would not show up as inflation. When consumers switch to a cheaper product, this does not show up in the CPI. So if you're eating soy burgers today and you were eating filet mignon 20 years ago, the government would say that there'd been no inflation, even though you needed to switch to a cheaper, quote-unquote, equivalent good. There's lots of other adjustments that are made, hedonic quality adjustments, etc. The index I like to use is called the Chapwood Index. I'm going to link to this below. And what this does is tries to come up with an objective measurement of inflation, much more objective than the CPI. This is obviously a private group. This isn't the U.S. government doing this. And so what they do is they basically just take the top 500 most frequently used items. And there's a list of them here. Obvious things like water and sewer, health insurance, gas, postage, all these different things. And they also do this regionally, as we'll see, which is very interesting. And they just toss this into a basket and they measure the price changes. And so there's not all this fancy government statistician manipulation. And the results are quite interesting, actually. And they, as I said, they're arranged by region. As we would expect, maybe inflation would be a little bit higher in places like New York and Los Angeles, really high cost of living areas, Chicago as well. And so what we can see here is it has inflation rates by year. So 2016 in New York, the actual inflation rate, instead of being 2 or 3%, as the government would say, was 10.8%. I like looking at the 5-year average here, very close to 12% for New York, 12% for Los Angeles, etc. And you can scroll down here. You can go to, you can maybe look at cheaper cost of living cities. So maybe in Charlotte, it's only been 8% a year. But if you just scroll down and you look at the right-hand column here, these 5-year average inflation rates, you can see that they are all basically 7 to 12%. And I believe this is a fair representation of the actual cost of inflation. So this is problematic, because what we're always told is that we have to invest and we have to grow our money at a faster rate than the rate of inflation. You have to stay ahead of inflation. If $20 only buys you a lot less, you have to invest that money at a rate that's faster than inflation in order to keep up and be able to, for example, afford the same amount of groceries. But if you think the rate you're supposed to beat is just 2%, you're going to invest very differently than if you think the real rate is 7 to 12%. Now, if we look at sort of annualized returns for things like the S&P 500, this is a Yahoo page, which I'll link to, we can see that the S&P 500 has done a pretty good job of keeping up with inflation over the past 3, 5, 10 years. So these are annualized numbers. Obviously, the S&P went up a lot more than this, but this is if it went up this amount every year for 3 years, or every year for 5 years, or every year for 10 years. We can see that the 10-year rate has pretty much hedged you against inflation, as has the 5-year and the 3-year rate. So S&P has been a fairly good hedge. This is one reason I like this as a long-term holding. I don't own it myself, but I think it's a very good sort of plain vanilla inflation hedge. Now, gold has been a little bit more problematic as an inflation hedge. Some of this just has to do with the fact that gold was near a peak 10 years ago and then really went nowhere for 10 years, which often happens. I believe gold over longer time periods is a better hedge. We can see it's gone up about 12% over the last 3 years, annualized, so every year, 8% over the last 5 years, and just 3%. We're gonna take another look at this if we actually go back and look at it over 20 years. 20 years ago on this date, gold was $273.50 an ounce. Today it is $1,939 an ounce. We can see how this has been a good inflation hedge, and that gives you an annualized return of a little more than 10%. So I think this is another sign, another piece of evidence that the actual inflation rate over the last 20 years has been about 10% a year, and gold has been a very good hedge. Gold is a very good store of value, or at least it has historically. Silver has had similar problems over the last 3, 5, 10 years. It's actually had a negative return. There was a bit of a silver bubble exactly 10 years ago that crashed. I don't like silver as much as a store of value because it has industrial uses. It's less of a pure store of value. So you get fluctuations based on industrial supply and demand. But gold, as we can see, gold in the S&P have been very good, especially if we look at gold over a 20-year time period. S&P has historically returned about 10% a year, and so that would make sense that it's been a good inflation hedge over the past few decades, and really since its inception. But I want to point out another asset. You probably know which way this is going if you've been watching my videos. What has Bitcoin done as an inflation hedge? If we look at its performance, I'm just going to look at its performance over the last 5 years. It's actually done much, much better than this over the last 10 years. And so I don't want to skew the numbers too much. But if we look at what the price of Bitcoin was 5 years ago today, it was $231 a Bitcoin. Today it's about $11,572. That gives us an annualized return. Again, this is not a total return. This is an annualized return of 118.73%, which obviously beats the inflation rate, the Chapwood inflation rates, by about 108% per year. This has enormous compounding effects. I would expect Bitcoin to continue to outperform like this. And so if we look at we saw the top here where the US dollar slowly losing purchasing power, and I think this is a great way to visualize inflation and the loss of purchasing power, you can't fill up your grocery cart as much. This is a little bit of an outdated meme, but if we look at Bitcoin, what it could fill a shopping cart in 2012, just the price of one Bitcoin. 2013, 2014, this was approximately when Bitcoin was around 200 or 100 or 200. As we saw in 2015, Bitcoin is currently at 11,500. You would need many, many shopping carts, or maybe you would just buy very, very expensive alcohol, as they have down here, to fill up a shopping cart. So Bitcoin has been not only a good hedge against inflation, but it's been a hedge above and beyond inflation that has made many people quite wealthy, and I believe will continue to make people quite wealthy. I'm not long the S&P 500. I'm not long gold, but I do have a large position in Bitcoin, and this is the asset that I'm most excited about over the coming years. Now, what is about to happen in the area of inflation? I think it's quite bad news, apart from the fact that we're just printing a lot of money. The Fed's still doing quantitative easing, where they print new money and buy assets and put it on their balance sheet. But there's a lot of talk, and I think this is going to be announced soon, that the Fed is going to change their inflation target to make it more than 2%. So instead of trying to target CPI inflation of 2%, they're going to raise it to 2.5% or possibly 3%. They'll maybe include a commitment not to raise interest rates at all until CPI inflation reaches 2%. And we can see it's really been scraping the bottom here. So it may take years and years and years to reach 2% again. This could mean that the government will really get behind the curve in terms of fighting inflation. So if the CPI here says 2% and Chapwood is saying 7 to 12%, you can imagine if they get behind inflation, in other words, fail to fight inflation in a timely manner, things could get really out of control. And instead of seeing inflation, I mean, if this inflation goes to 3%, which would be roughly 50% higher, that could mean we see actual inflation rates of something around 15 to 18%, which is quite devastating when it compounds year after year. And the CPI index may never move back up. It may continue to be manipulated. And so you won't even know what's happening, except you'll know what's happening in your checking account and with your credit card when you see how your dollars are not going as far as they used to. This is why I like to hold a substantial portion of my net worth in Bitcoin. Now, you have to size it correctly because it can also go to zero. That's the problem. But it can easily go up 10, 50, 100 times from here over the coming years. And you can check out some of my other videos on Bitcoin if you want to know the details of this. But I think everyone needs to think about the coming inflation, especially if the Fed wants to increase inflation by printing more. And we can be sure that this will not show up in the government inflation propaganda statistics. Please hit that subscribe and like button if you found this video helpful. Hit the notification bell so you'll be notified when I post my next YouTube video. And let me know your questions and comments in the comment section below. Thanks a lot for listening, and I'll see you in the next video.